Hello and welcome to this short presentation on how an effective cash management proposition can enhance your treating customers fairly policy. We probably don't need to be reminded of the Financial Conduct Authority's attitude towards treating customers fairly, so it goes without saying that it remains central to their expectations of firms' conduct and that firms put the well-being of their customers at the heart of how they run their businesses. So, in the interest of keeping your clients fully informed, one of the main objectives for the financial advisor is to make sure that clients fully understand both the positive and the negative aspects of any advice that's been provided. And when a recommendation is provided without meeting these requirements, the regulator will take an interest in the overall TCF outcomes demonstrated within the business and will hold the financial advisor liable for any losses experienced by the client. So let's have a look now at a few areas where we already know there's a requirement to fully inform the clients of the values and benefits, both positively and negatively, of seeding schemes. So we have pension transfer business, investment switchings, moving mortgages or remortgaging, and also any advice provided on annuity at retirement. We could also throw into the mix there critical illness policies. And it's quite clear that where a financial advisor fails to give the client the necessary information, they will be held 100% liable for any financial loss that the client may incur. So it's very important that the financial advisor avoids this situation. Okay, so let's take the principles from the previous slide and have a look at how they relate to investment advice provided to a client where their money originates from a cash product. So let's have a look at a few facts first and foremost. It is a fact now that we know that it's possible to beat inflation on the net return offered by cash for all levels of taxpayer. It's also a fact that cash offers levels of protection not available in the investment market. It's a fact that everyone needs cash. It's also a fact that cash is a short-term and a low-risk solution. And it's also a fact that equity-based investment products could provide better financial value over the longer term. The key word here is could. And this needs to be taken under serious consideration given the performance of the stock market from as early as 1995 and how cash would have outperformed a lot of the indices and a lot of investment portfolios over the last 20 years. So if we now refer back to the previous slide and an investment is ever undertaken without fully informing the clients of all of these points, the advisor is in a very, very weak position to defend a complaint and is therefore highly likely that should the complaint go to the Ombudsman, that compensation would have to be paid. Another key point here is the fact that should we really be waiting for complaints to go to the Ombudsman, because even if a financial advisor in a financial services firm never has a complaint held against them, they will be carrying this inherent risk within their business, and therefore when they come to pass on or sell their business, this level of inherent risk will undermine the value of their business. Okay, so over the next few slides, let's have a look at the 6 TCF outcomes that the regulator requires every financial services business to demonstrate. So outcome 1 requires that consumers can be confident that they're dealing with firms where the fair treatment of customers is central to the corporate culture. And if the business model is based upon clients having to remain invested for the financial advisor or the business to get paid, it's very difficult to demonstrate fair treatment at all times, because there will be times when clients are better served by having their money held in cash and divesting from investments. Nevertheless, and irrespective of this, at all times the client should be made aware of the beneficial value of any money that they hold in cash compared to the beneficial value of money that they have in an investment portfolio. So if you can demonstrate that your commercial proposition is not affected by the amount of money your clients have invested, you can definitely demonstrate the confidence that your clients can have in your service. So providing every client with a bespoke cash management service to demonstrate the value of their cash is a fundamental part to meeting the requirements of outcome 1. So outcome 2 requires that products and services marketed and sold in the retail market are designed to meet the needs of identified consumer groups and targeted accordingly. So how is it really possible to demonstrate that products and services are targeted to the right groups if the major asset class within the market is excluded from the proposition? How is it possible to demonstrate it if you can't properly demonstrate your client's needs for cash and how to best manage it? Because all clients have cash and it's the only product or asset class that everybody requires before they make an investment. So any advice recommending money is moved from this area cannot be fully justified unless a full analysis of the cash performance is delivered to the client for them to see clearly the difference that an investment proposition or solution can make to their position. Similarly, and we can see here how all these points are interlinked, that consumers are provided with clear information and are kept appropriately informed. So what information is actually provided to the consumer to show the beneficial value comparison between cash and investments? And how does a client know if they need to keep their money invested if they have no idea of what they could achieve from the alternative, and also vice versa? So providing your clients with a cash management report every year to keep them appropriately informed will not only protect the client, but it will also protect the advisor and their business. So outcome 4 requires that consumers receive advice that is suitable and takes account of their circumstances. So again, how is it possible to take account of a client's circumstances and to give suitable advice if the major asset class that underpins everybody's lifestyle and therefore should underpin every single piece of financial advice, if that's excluded from the proposition and the solution? How can suitability really be demonstrated? And I think the basic indicator here is the fact that almost 70% of complaints that go to the Ombudsman are upheld by the Ombudsman because the client's attitude to risk has not been determined appropriately. And this for me is fundamentally the reason why. If clients don't understand their cash, then their attitude to risk cannot be clear, because their attitude to risk could change if they knew they could beat inflation in a safe and secure manner. So we continue on to outcome 5, that consumers are provided with products that perform as they have been led to expect. And the only asset class really where you can guarantee that the performance will be as expected is cash. So every time an investment portfolio is recommended without a cash management report underpinning it, the advisor is undertaking a degree of risk which is not necessary. Simply explain your client's cash position, explain the fact that it's a short-term asset, and explain the fact that exposure to longer-term equity values is still required to maintain and manage the value of all assets and capital moving forward. It doesn't result in less business being invested. In fact, in many instances it results in more business ending up within an investment portfolio. But without that report, the advisor is leaving themselves exposed. Finally, outcome 6 requires that consumers do not face unreasonable post-sale barriers. And the point here is also that in actual fact financial advisors should not expose themselves to unnecessary complaints. But the reality of the matter is if a client is led to believe that investments will preserve their longer term value of their capital, and then that capital that's invested falls in value and they end up with less than they put in there, they have cause for complaint. These are the complaints that are going to the Ombudsman, and these are the complaints against which 70% of them are being upheld. If you had a cash management report with your clients and you were helping them to underpin their investments with their cash, these complaints would either disappear because the client's propensity to complain would be lower, or they would be better defended because a cash management report on your file with every single piece of regulated financial advice will help you to better identify your client's attitude to risk, and will also put them in a better position to understand the value of longer term ongoing risk from investment portfolios. Okay, so quite a lengthy one this. I hope you've found the presentation interesting and given you some food for thought. If you would like more information on either how to effectively manage cash, or on how to engage or integrate an effective cash management proposition into your business, please contact us on any one of the methods shown below. So thank you once again for listening, and we look forward to hearing from you.